Okay, good morning, my friends. Today we are going to be looking at the double entry principle. My name remains Dr. Akandevi Chuks. The double entry principle is a basic principle in bookkeeping and accounting, and if you can understand it well, you'll be able to do a lot of things as it relates to bookkeeping and accounts. Now, all transactions have two effects. All transactions. For example, if Mr. A buys a bottle of milk from a store, say Zenith Shop, I would like you to take note of Zenith Shop because we are going to be using that name often in our lectures. So if Mr. A buys a bottle of milk from a store, say Zenith Shop, and pays cash to the shopkeeper, who in turn releases the bottle of milk. Now, to the buyer, cash balance will decrease by the cost of the bottle of milk, while in turn he gets a bottle of milk. So you see, there are two effects to the buyer. To the seller also, he is short by a bottle of milk, while cash balance will increase by the price of that bottle of milk. So what does it mean? There is a double entry effect on both the buyer and the seller. Consequently, if we take the book of Zenith Shop, for example, the two entries that will be required will be: one, the entry that will increase the cash, and two, the entry that will recognize income. So you could see, therefore, that we are going to be looking at two accounts. The first account will be the cash account, so that it will show how the cash increased, and the second will be the revenue account to show how the revenue also increased. One of the entry will be a debit one, while the other will be credit. So what it means, therefore, is that the example expresses the double entry principle. And what is the double entry principle? For every debit entry, there must be a corresponding or an equal credit entry. For every debit entry, there must be a corresponding credit entry. Or for every debit entry, there must be an equal credit entry. That is the double entry principle. And I would like here, before we continue with the example above, let's explain two concepts. Number one, the accounting equation, and number two, account balances for the classes of account. It will help us to understand the double entry principle further. Accounting equation. The accounting equation states asset is equal to capital plus liability. The accounting equation states asset equals capital plus liability. We will quickly explain the meaning of these three words. Now, what is an asset, or what are assets? Assets are entities, resources. That is, those things the company owns. For example, the cash, the accounts receivable, the inventory, which we also know as stock, prepaid insurance, or in fact all prepaid expenses, investments, lands, buildings. They are all assets, and the assets are divided into two. We have the current assets and the non-current assets. Also, we have here assets must equal the liabilities plus owner's fund or owner's capital or owner's equity Now, liabilities can be seen as an entity's obligations. That is the amount the company owes. The company could owe insiders like the employee, salaries and wages that are payable that had not been paid, or could hold outsiders, creditors, and so on and so forth. So we could take examples: loans payable, accounts payable, salaries and wages payable, interest payable, and if it is a regular corporation, income tax payable. Now, what is capital? The capital could also be referred to as net asset. Net asset. That is asset minus liability. It could also be referred to as equity. That is the owner's contribution to the business that does not include money borrowed anywhere, or does not include assets borrowed anywhere. The capital can also be seen or referred to as the entity's net worth. The entity's net worth. Now, quickly before we go back to our example, let's look at the class of accounts. There are 5 major categories in which accounts are divided, and these are the assets, liabilities, capital, or which we could call the net assets, revenue, and expenditure. If you look at these classes of accounts, you will discover that on our accounts equation, we had the first 3: asset is equal to capital plus liability. So these first 3. Then the last 2 are revenue and expenditure. Why it's like this is that the first 3 is what is shown on the statement of financial position, otherwise known as the balance sheet, while the last 2 is shown on the profit or loss account. Good. Now, if you look at these categories of accounts, we could give it an acronym which is referred to as ALCRE. ALCRE. A-L-C-R-E. ALCRE. Now, we want to look at what are the balances for these classes of accounts. The first word here, A, which is asset, and the last word, E, which is expense, they have debit balance, meaning that for assets to increase or expense to increase, you must debit those assets. Therefore, if any event took place that will reduce the assets or the expense, then you have to credit those class of accounts. I repeat, assets and expenses have debit balances, meaning that whatever will increase asset or increase expense must be debited. Otherwise, it will be credited. Going further, liability, capital, and revenue have credit balances. So whatever will increase liability, capital, or revenue must be credited. Otherwise, they will be debited. Okay, now back to our example. Let's assume Zenith Shop started the business with 1,000 naira. He bought 4 bottles of milk for 200 naira each, sells a bottle of milk for 250 naira, and had 3 bottles left. Also, let us assume the shop is online and no rent is paid nor transport incurred. So what will the double entry be? Remember, there are three transactions here. One is that the owner of the business injected 1,000 naira. The second is he bought 4 bottles of milk at 200 naira each, which will result to 800 naira outflow of cash. Then he sells a bottle of milk for 250 naira. So there are three events here that we'll have to look at the way they will be entered in the books. Okay, now we are assuming that all those three events were cash transactions. So we are not looking at any credit transaction yet, so that we can understand the principles gradually as we graduate. Now, the first transaction was 1,000 naira that was injected into the business. Now, 1,000 naira was injected by the owner of the business. So that means that 1,000 naira is the capital or equity of the owner to the business. So what are the two accounts that are involved? Remember, we are dealing on the double entry principle. The first account here is the cash receiving equity from the owner. So the cash received equity, while equity also will be recognized, or capital will be recognized. So cash here now is receiving. Remember, ALCRE, asset, if it's increasing, must be debited. So cash is an asset, and so it has to be debited because it is increasing by the equity of the owner. So we debit cash with 1,000 naira, and we credit capital, as you can see here, with 1,000 naira. So that is the first transaction. The two accounts that are involved is cash and capital. Again, it was stated that Zenith Shop bought 4 bottles of milk at 200 naira per bottle. So what are the two accounts that are involved? Simple. He bought via cash, and so we are going to be looking at cash and purchase, because he purchased. So purchase account and cash account. So remember again, because the purchase is reducing the asset, and remember, our ALCRE asset has a debit balance, so whatever is increasing asset must be debited, but when it's reducing asset, it will be credited. So purchase therefore has to credit cash account, and so we are crediting cash account, as you can see here, 800 naira, and we go to the purchase, which is the next account. We debit purchase 800 naira. We debit purchase 800 naira. So back to the third transaction. Now the third transaction is sales. We sold only 1 bottle, and we sold it for 250 naira cash. So cash is also going to be increased by 250 naira. Therefore, we debit cash account because it's increasing the asset. So we debit cash account with 250 naira. We have been able to look at the 3 transactions that took place in this example. So let's balance the cash account. We just add 1,000 naira plus 250, we give you 1,250 naira. Then we have only purchase on this side, so 1,250 naira minus 800 naira will give us the cash balance, which is balance carried forward of 450 naira. Note, this is the cash balance remaining at the end of the accounting period. So capital account remains 1,000. Purchase that was made within that period is 800 naira, and sales remains 250. And so it's good we note this. There was a closing stock arising from selling only one bottle of milk. So we have 3 bottles remaining at 200 naira per bottle. How will the income statement look like? Income statement. Sales. Remember, we sold only 250 naira, which we took from the sales account. Let's go back and see the sales account. Sales account 250. So it's only 250 that we show on the sales account. Then purchases, if you remember, it was 800 naira. And remember that there was a closing stock. You have to less the closing stock from the purchases to get the actual cost of sales. This 200 naira now is referred to as cost of sales. So 250 minus 200 will give you the profit of 50 naira, assuming that no other expense took place. So we have 50 naira. And how will the balance sheet or statement of financial position look like? The statement of financial position now will be, remember that accounting equation is shown here on the statement of financial position, and is saying that asset must be equal to capital plus liability. Now, asset here is the inventory, which is 600 naira. That is the bottles of milk that remained unsold, and the cash balance is also an asset, which is 450 naira. By the time you sum these two up, you will get 1,050 naira. Now, how was this asset financed? It was financed by the capital, which is 1,000 naira. That is the equity ejected by the owner of Zenith Shop. And it was also financed by the profit that they made, 50 naira. Now, the new capital now is 1,050 naira. The new capital now is 1,050 naira. So we could say asset is equal to capital, because here liability is 0. Liability is 0. So it does not have any obligation to pay anybody on a later date in any way. So asset is equal to capital. Now let's go further by assuming that some other things took place also in that transaction. Let's assume that he sold the remaining 3 bottles for 300 naira per bottle. He sold the remaining 3 bottles. You remember, he bought 4 bottles of milk. He sold 1 the last time, so he has sold the remaining 3 bottles. He also paid transportation to distribute the bottles of milk, totaling 100 naira. And he purchased 5 additional bottles at 200 naira per bottle. Now, how will the transaction look like, bringing in these other 3 transactions? Remember, on our cash account, we had capital already. We had the sales, the first sale, which is 250. We also had the first purchase, which is 800 naira. So let's not forget that he now sold the other 3 bottles, which is at 300 naira each. So 300 times 3 will give you 900 naira. And remember, we had already discussed that when there's a cash sales, the 2 accounts involved are cash and sales. So let's see sales account. Let's see sales account. This is the sales account. So sales is credited. Remember, sales is revenue. So whatever increases revenue is credited. And whatever increases cash is debited. So that's what we've done. We've debited cash and credited sales, which is revenue. Also, the purchase, first of all, there was a transport fare expense. I remember transport fare expense. And now it was done via cash. We are assuming cash transactions all through. So it was done via cash. And so it is, since it's an expense, it's an outflow, it is reducing cash. So we have to credit it. We have to credit it. And as you are seeing it here, it has been credited. Then you go to that expense account, which is transportation, and debit it, and it's coming from cash. Okay, now finally let's look at the purchase was made 5 bottles of milk at 200 naira each. So it is also reducing the cash account, so it has to be credited, and the purchase account debited, as it's shown here. Purchase account debited. So those are the other 3 transactions that took place, and we have to now balance our account. How do you balance? We've done it before, but let's just reiterate here. 1000 plus 250 plus 900, the debit side first, you add up all, because under normal circumstance the debit side should be higher than the credit side, unless of course if you have overdrawn your cash. That means that you are owing somebody somewhere. If not, normally your cash account must be higher, or should be higher. However, when we go to cash book proper, you will understand where there are variances. But for now, let us add up and get the balances. 1000 naira plus 250 plus 900 will give you 2150 naira. Now you add the credit side, 100, 800, 1000, you will get 1900. So 2150 minus 1900 will give you 250. So we have a cash balance of 250 naira. Our purchases has increased to 1008, and sales also increased to 1150. So how will transportation has been included, 1100 naira. So how will our income statement look like? First of all, note that 5 bottles remained unsold at 200 naira per bottle. Therefore, the income statement will be sales. Remember, it's 1150. Then the purchases is 1800. Closing stock is 1000. So if you subtract 1000 from 1800, you will get 800, meaning that 800 is the cost of sales. So 1150 minus 800, our gross profit will be 350 naira. Now, what am I trying to explain here? Gross profit is gotten when you subtract the cost of sales from the sales. So you get your gross profit. Now, transportation is an expense. So when you less the 100 naira from the 250, from the 350, you get 250, which will now give you your net profit. This is a simple illustration of an income statement, and but we will go further on the income statement as we proceed on these lectures. This is our area of concern, statement of financial position, showing the accounting equation. So asset here now is the 1000 inventory. Remember, 5 bottles were bought, and we didn't sell any. So cash 250, we add the 2, you have 1250. So what is your capital going to look like? The capital is 1000 naira, and the profit has increased because of the additional transactions to 250. So you have 1250. Still, asset here is equal to capital because liability is still 0. Now, in the next class, we will add other transactions such as credit sales, injection of new capital, borrowed funds, etc., etc. Please join us in the next class for further illustrations and lectures. Meanwhile, please subscribe by just hitting the subscribe button so that you can be notified when we display the next lecture. God will bless you. God will protect you. God will guide you. Thank you very much for listening. And please don't forget to send your questions, send your observations, so that we can improve on what we are doing to ensure that the right knowledge is disseminated. God bless you. Bye for now.